these reports, we have our partner Thomson Reuters, and before that we had Sibafi as well as our partner in producing these reports. So this report, we started working on this report for like about 3 months back. Had no idea what exactly is lying in Pakistan in terms of Islamic finance. So we set up a team and we looked into several things, and we learned a lot from this experience. The most important element that we have found while studying about Pakistan, about research in Pakistan, that Pakistan is moving forward with a greater pace now. The experience of 1980s, where Pakistan has tried to convert the conventional system into by using the word Islamization, and did not produce the result what was expected. And starting from early 2000, the view that we can work in a dual banking system, in a dual financial system, where a gradual change will come over the period of time. So this failed experience and the new experience of dual banking was an interesting study that I would say that we have learned a lot from it. Second thing that I would say, which we think is really important to mention about this report, is the windows of Takaful operations. It just started last year, and we see enormous growth in this window operations. Sukuk issuance is again an important element for the Islamic capital markets in Pakistan. But I would say the cream, the cheese, the cherry on the cake. I'm sorry, I love the cake, so I'm telling you everything about the cake. So the cherry on the cake is the Islamic asset management, the enormous growth in terms of the asset size, the enormous, the really good return for the small investors. And I would appreciate when I was reading the whole story and was discussing with other co-authors on the report, the establishment of Pakistan Stock Exchange is a great milestone. Especially this KMI, I don't know whether the name is changed to PMI or not.
It's still KMI.
So it's the KMI index. The KMI index was definitely was a starter of the Islamic asset management industry. I would say another aspect that that came as a personal favorite was the Islamic microfinance sector, especially Akhuwat, Wasila. These are the organizations that have started work, and they are giving us good examples how we can use how we can provide interest-free financing facility to small borrowers that will definitely increase the financial inclusion. We know that State Bank of Pakistan has recently done a CAP study, and in that they found that there are people, especially in the lower strata of the economy, that are not really interested in doing banking with conventional banks, and they're not willing to borrow from banks. So if we provide them the opportunity, if we provide them the financing using Islamic modes of financing, that will reduce that self-exclusion from the main financial system and would increase the financial inclusion.
Thank you, Dr. Daud. You briefly sum up the key findings. Now, my next question is to Dr. Iram. This report also highlights some recommendation, the practical recommendation to the Islamic finance industry, as well as to the regulator. So I would like you to briefly discuss on those key recommendations for the stakeholders.
Okay, thank you very much, Mr. Ahmed. Actually, in this report, what we found is basically for the Islamic financial institutions in Pakistan, they need to create awareness. Actually, they themselves know very well that there is a lack of awareness. People in Pakistan are not aware about Islamic banking products and all other Islamic banking concepts. So one of the things that we recommend to Islamic financial institution in Pakistan is basically to create more awareness. This is number one. Then secondly, through this report, we would like to recommend to Islamic financial institutions that they have to spend a lot of money on the research and development, because we need to have more innovative products actually. And number third is basically that Islamic financial institutions have to also spend on the technology side. So not only on the Sharia development side, but also on the technology side, the banks have to come up with the new modern tools, more towards the fintech and Islamic branchless banking. So all these things we recommend to the Islamic financial institutions. But when we talk about the regulator, we do appreciate for this particular report that our regulator, State Bank of Pakistan, and especially Securities and Exchange Commission of Pakistan, they have helped us a lot. And they are doing so many things, but still there is always room for improvement. So regarding the room for improvement, what we recommend in our report is basically that the State Bank of Pakistan should give some incentives to the conventional banks to convert into full-fledged Islamic banks. This is one of the way that we can actually enhance the penetration of Islamic financial institution in Pakistan. Secondly, another thing that State Bank needs to come up with is basically to have separate prudential regulations for Islamic financial institution. If we have separate prudential regulations for Islamic financial institutions, especially Islamic banks, then this will take care of all the anomalies in the legal and taxation side. So this is number two. The third recommendation for the central bank is basically that they need to give us more liquidity management instruments to the industry, because right now industry is direly looking for the more liquidity management instruments. So this is basically for the State Bank of Pakistan. And when we talk about the Securities and Exchange Commission of Pakistan, they established their own department last year. But what they have to do is basically now they have to take care of mudarabas, Islamic insurance, give some incentives to the takaful operators. Now the good thing is conventional insurers can start Islamic insurance, but there is a room for improvement. We need to have separate set of rules actually for the takaful operators. So these are the recommendations not only for the Islamic financial institutions in Pakistan, but also for the regulatory bodies in Pakistan.
Thank you, Iram, for briefly summing up all the key recommendations. Now I move to Brother Mustafa. This report also highlights the key steps, especially the takaful sector coming up and with the allowance of the windows. So what opportunities you see for the takaful sector in Pakistan, especially the report also mentioned something about micro takaful as well. So at both level, at the general and family level and also at the micro level.
Sure. Thank you very much for the question. I mean, basically, the insurance industry in Pakistan is very, very interesting, right? Pakistan is a very underpenetrated insurance market in general.
That might
This one's better?
it's better.
Yeah. Sorry. So what I was saying is the insurance story in Pakistan is something that's very interesting. Pakistan is a very underpenetrated insurance market as it stands today, with total insurance premiums being less than even 1% of the GDP, whereas in many developed countries you see it in excess of 50% or more. Now, with the growth that is projected for Pakistan economically, and with increasing urbanization and sophistication of the population, you're going to see a growth trajectory on the insurance side. And currently, our report found that the takaful institutions are not equipped to be able to capture that growth, right? So the decision to allow windows and the decision to issue these regulations around takaful was a very important key step to really build in the capacity within the industry to be able to absorb some of the growth on the insurance side. Another key finding which we had was that, the insurance sectors are very much focused on particular niches. And unfortunately, they, like many of the other financial services that are provided, they exclude a significant portion of the population. One of the key requirements that the industries have is for micro takaful, for small entities and small businesses and micro entrepreneurs. Things like bank takaful to supplement the offerings that current financial institutions offer. And obviously to have a re-takaful entity, to really be able to allow the growth of the takaful space, you need to have significant institutions with significant capital to be able to capture and to provide the re-takaful services for smaller operators to operate. So I think that there is consensus amongst the regulators. Definitely, through our experience and our interviews with them, we know that they have a roadmap in place to support not only the product development on the financial inclusion side, but also to build up capacity within the industry to capture this growth on the insurance side. And I think that the recent regulations that were issued that allowed windows is a very strong first step on the journey. But there are many other steps that need to be taken, and we're quite confident that the regulator is moving in the right direction to be able to enact that.
Thank you, Mustafa. Now I'll move to Dr. Zamir Iqbal, who is an independent expert, who is not part of the report panel, but he has, based on experience at World Bank, we invited him for his experts coming. So Dr. Zamir, first I have two questions for you. What is your overall view on this report, how it will contribute for Pakistan? And also, just as specific, this report put Pakistan's overall ranking in Islamic finance at number 6. So still a long way to go. So how to be on the top of the list?
Bismillah ar-Rahman ar-Rahim. Thank you, Ahmed, for giving me an opportunity. And I must, first of all, congratulate ITHI, Center for Excellence of Islamic Finance, and Thomson Reuters for doing such an excellent job. I think the report, I was very pleased to see that report has turned out to be a very good product. There are many positives in this report, which if one takes time to go through those things. So you can see that many positive developments are being mentioned in this report. Just a couple of ideas which I want to bring to your attention. I think if you look at, maybe it also answers your second question. I mean, couple of things, if you look at the many countries that how Islamic finance has developed, there are two models. One model is basically a top-down approach, where you get the support from the very top policymakers and the stakeholders, and this is basically an effort is made, and that's how the Islamic finance develops in that country. The other model is bottom-up, where you see that the country says that let the market determine and let the market see how to develop Islamic finance. And that it depends purely on the demand and supply factor and the other enabling environment. I think this report gives you a very positive message from the policymakers, whether it is the bankers or whether the Securities Commission or other stakeholders. The message is very clear that there is a support from the top, from the policymakers, and there's a support from the stakeholders, and there's a seriousness. And I think some of that you could also see in the speeches from this morning, that there is a commitment. So this is a very positive thing which is coming out of this report. I think the other thing is it has highlighted many areas of improvement which are very obvious. I think it clearly shows that there's a need for better knowledge management, there's a lack of capacity, technical capacity, and I think for that places like your center and at Lams and Peshawar, I think they can play a very major role. Actually, organization of these events and distribution of this book could also be a very positive, can contribute. I think one thing which Pakistan may consider, I think one of the things which I have seen in many conferences, that suddenly the focus on Islamic finance or the utility of Islamic finance is somehow constrained only to microfinance or financial inclusion. I think that's not a good trend. Islamic finance has much more to offer. Do not constrain Islamic finance only to inclusion or social finance. Islamic finance is much broader. It is if I kind of say it has a much more potential. As we have heard from speakers, it has the ability to be much more stable, anti-fragile, and many other things. So I think that part is very, very good. Other thing which maybe Pakistan should consider, and probably one of the survey answers sees that what are the areas where there needs to be more product development, and it identifies SME as an area where there's more product development. And I think given that what is happening in the international banking system, that the banks are being asked to be having less leverage, Therefore, banks are reluctant to get into this risky business of SMEs or even microfinance and those things. I think that prompts us to think about how to mobilize non-banking financial institutions which are being utilized on the, on maybe, in Pakistan has one of the country where there's a very kind of long history of mudarba sector. So these non-banking sector could be strengthened further to address the issue of SMEs and small entrepreneurs. So I think with that, I will conclude that again, congratulations for producing such a high quality document. It will certainly be very helpful for the decision makers and the other policy makers who are the mid-tier management, and they can realize the importance of this growing sector. Thank you so much.
Thank you, Dr. Zamir. And there is much more exciting facts and figures and analysis in the report, and I would like to urge all of you you can go to the website and you can download the report. And yes, we tried to give you a glimpse of what is inside, but the real taste is when you read it, and you will find it is very beneficial, and a lot of hard work has gone into the report. And to conclude this session, I would request Dr. Ishrat Hussain, who is also the session chair, to say the concluding words about this.
Thank you very much. I think all these speakers have made very useful contributions about the report. The purpose of this first report is to present a snapshot status of Islamic finance industry in Pakistan in a systematic way. And this will become the benchmark from where the future reports will evaluate the pace and extent of the progress we have made. And that, I think, is the first useful lesson we should take home, that this is not the end, this is the beginning of a long drawn process. The second point I would like to make is that at the end of these 2 days, we have to have a roadmap. However imperfect, tentative this roadmap may be, but we have to force ourselves to be more precise and converge towards a consensus as what can be done in the short term, in the medium term, and in the long term. So you don't have everything being done overnight, because that's not feasible. There are some things which can be done. So for each session, I would very much hope that the session would focus on the ingredients and the elements of this roadmap. And that will help us in the concluding session to have a picture as to what needs to be done, by whom, and that's what the center will take away for further work. And the next year's report, which we will produce, will make an assessment as to how much we have done in order to meet the commitments we had made in this roadmap. So it's also a discipline for us at the center in order to measure as to what is being done, who is doing it, and whether we have succeeded or failed. And if we have not been able to accomplish, or we have failed, why we have failed, and learn from the failures for improving this. Because I totally agree with Taqi Usmani Saab. I have been in this business now for a very long time. I don't know how many conferences and seminars I have attended on Islamic finance all over the world. And we just do not have a very precise metrics to measure as to what we said in 2010, and now we are in 2016. It seems we are just completely repeating ourselves. So we're standing and jogging on the same place. We have to make progress. And this report, I hope, from next year onwards, will make that evaluation and that measurement to guide the industry as to what is really happening and how much progress we are making. So with this, I want to congratulate the authors of this report who have worked very hard. This is the first attempt, and I'm sure that the industry will benefit from it, but I wanted to leave some thought for the future. Thank you very much.
Thank you very much, Dr. Ishrat. And with these words, I would hand over the mic to Mr. Raza.
Thank you, Dr. Saab, and the eminent panelists. I would request Dr. Ishrat Saab to please present a token of thanks to our panelists. I request the volunteers to please Dr. Ishrat will present the plaque to Dr. Zameer Iqbal Saab. Just for the information of everyone here, this is a handmade calligraphy, specially designed for this particular event. To follow, we have Dr. Dawood Ashraf. I would request Dr. Ishrat to present this memento, this token of appreciation to Dr. Dawood Ashraf. The next memento will be presented to Mr. Mustafa Adil. The next one to Ms. Iram Sabah. As I already informed, she's also part of the organizing committee for this event. And lastly, to the moderator of this session, Director Chief, Mr. Ahmad Ali Siddiqui. He will also receive the memento from Dr. Ishrat. Thank you very much. We'll have a group photo. Ladies and gentlemen, let me tell you one thing. We are really running against time. We have a real tough schedule in front of us, and we have to ensure that we manage to close it right in time. And for that, I would request all the presenters, all the panelists to please ensure that we follow the time given to them so that we are able to conclude at the right time in the evening, inshallah ta'ala. In fact, I've been asked by the organizers not to talk much, but to do more. So I'll be doing more, inshallah. So next, we'll be moving towards our research papers. As already mentioned, in this conference, we have global members of academia who will be presenting their research papers today and tomorrow. Today we'll be having 5 research papers, 3 before lunch, and inshallah ta'ala 2 after lunch. For the first 3 papers, let me call upon the session chair of this session, Professor Dr. Abbas Mirakhor. I request him to please come to the stage. He will be the chairman of this session. The first research paper which we will be inshallah ta'ala presenting will be on SMEs access to finance in South Asia. Can Islamic finance be the catalyst? And this paper will be presented by Dr. Zameer Iqbal. I request Dr. Zameer Iqbal to please join us on the stage. Then the second paper will be is on the effect of implicit market barriers on stock trading and liquidity, the case for Islamic finance. And this paper will be presented by Professor Dr. M. Kabir Hassan, who is a professor of finance in the University of New Orleans. I request Dr. Saab to please join us on the stage. And finally, the last paper of before lunch session is on financial innovation, oversubscription, and financial crisis in Islamic finance. And this will be presented by Mr. Dr. Saad Azmat, who is a professor of finance at LUMS. I request Dr. Saad Azmat to please join us on the stage. Thank you very much. And it's over to you, Dr. Abbas Mirakhor.
بسم الله الرحمن الرحيم والصلاة والسلام على سيد المرسلين وخاتم النبيين محمد وآله الطيبين الطاهرين. It's a pleasure to chair this session for all of these three papers that are going to be presented. Since we are short of time, I will, without any further ado, turn the podium to Dr. Zamir Iqbal for his presentation.
Can we get the presentation? Bismillah ar-Rahman ar-Rahim. Again, thank you so much, Mr. Chairman. It's my pleasure to be here, and I thank Center for Excellence for Islamic Finance to give me an opportunity and give me a chance to be here and present the paper. Now, this paper, which deals with SME finance, was actually specially done for this particular conference, and I will try to give you an idea that why we thought that it's very important to discuss about SME finance and Islamic finance. There is quite a bit, I would say, natural fit between the problems of the SME financing and the potential solutions and what Islamic finance has to offer. So I'm just waiting for the presentation, if we could have. No, I don't. I mailed it. Anyway, I mean, I can just give you some justification why we chose talking about the SME. I think one of the main issue is that you have heard this before, that access to finance is one of the very major issue, which is quite a bit hindrance to economic development. And there are about more than 1 billion people who do not have access to finance. And 73% of those words, 73% of the population are unbanked. This is quite a bit statistics, which is quite a bit. Yes, I think this is the presentation. So this tells you that about 73% of the people are unbanked. They do not have access to any finance. And within that 73%, about 22.2% people who are coming from Muslim countries. And we'll be surprised that why this is almost 1/4 of all the people who have, do not have access to finance. And these Pakistanis, of course, included those. Pakistan, about 5.2% people do not, of that 73% do not have access to finance. Now, because of that and many of other things, you may have heard about the Sustainable Development Goal, and they're trying to achieve the promotion of entrepreneurship and access to finance. And World Bank has launched a special initiative called Universal Access to Finance. So the target is by the 2020, if they could make every adult human being could have access to some form of either banking or some electronic payments or some other way of dealing with the banking sector. And that has an implication at a micro level as well as the macro level, and studies have shown that that will take us to, okay, I think we can maybe work something like this. I was telling you what is the motivation for our study. I was telling you the statistics about access to finance, and then talk about our universal access thing. Now, I think now coming back to the SMEs, we have a serious issue that SMEs do not have the gap which is known as the financing gap for SMEs, is huge. The highest gap, which is about 92% of the SMEs do not have access to a formal finance, is in East Asia and Pacific, and South Asia is number 2. And South Asia has a funding gap of about 36%. That 36% of those, about 78 million SMEs, do not have access to any form of finance. And the other issue is that about 400 million of SMEs which are in developing country, only 26 million are in the formal sector, which is again a very kind of an eye-opener that given the importance of SMEs, they are really deprived of finance. So I'm just going to, these are some of the tables I was showing you about the SME finance. Now, again, we did some further study, and if we look at what are the key impediments, and all this study is based on the World Bank Enterprise Database, and that database tells us that in South Asia, what are the 3 prominent issues with respect to SME finance. And when it comes to South Asia region, it talks about 3 key areas are, first is corruption, access to electricity, and third is access to finance. Now, if we compare that to the rest of the world, access to finance is the major problem, but within South Asia, within SMEs, small enterprises have a much bigger challenge in terms of access to finance than compared to the medium and large. So one thing is very interesting, that medium and large enterprises have relatively better access to finance than a very small medium. And when we compare this thing with, within this thing, we look at what is the difference between the OIC countries and non-OIC countries within South Asia. Now, within South Asia, there are at least 3 or 4 OIC countries, which are Pakistan, Bangladesh, and Afghanistan. If you look at what is the difficulty in accessing finance, if you look at the rest of the world and the South Asia, you will see that pretty much the difficulty is comparable, is pretty much same. But when you compare them, the OIC countries and non-OIC country, you will see that in all 3 categories, whether it's a small, medium, or large, all 3 categories have a more difficulty to access to finance. So this shows that all firms, regardless of their size, in OIC countries in South Asia have much higher degree of access to finance. So there is something which needs to be done, that in the Muslim countries, predominantly Muslim countries, why the access to finance is much more difficult compared to their benchmark. Now, we did an empirical study. I don't want to get into too much of a technical thing. We don't have enough time. I was told that we need to short the presentation. Our methodology is basically we look at different firm characteristics in terms of their age, their sectorial decomposition, their location, mean location, small versus city versus large city, the type of ownership, whether they're export oriented or non-export oriented, and then we use a special technique, which is rather a different technique of looking at how different variables interact with each other. It's called seemingly unrelated regression model, and we take this and regress this thing against the access to SME. So we try to see that which variable out of these, and we put variables like OIC countries, non-OIC countries, we all put this together, run our model, and see what our results are. Now, we look at it from 2 different angles. We look at the issues from the working capital, and we look at from the fixed capital aspect to understand what are the different, what are the differences. Now, one thing is that for SMEs, bank lending is almost very, very low. And I think that is understandable given that banks are heavily regulated. They are, issues of they're too much leverage and to be deleveraged. Of course, they stay away from any risky sector like SMEs. So the SMEs tend to be for both capital, working capital as well as the fixed capital, they tend to rely more on internal funds than the equity or than the bank lending. Interesting thing was that again, when we look at the South Asia versus rest of the world, we do see that South Asia has same, the bank lending is slightly better for SMEs, but when we look at within the OIC countries, you look at the right-hand side on the top for working capital, you see that OIC countries, bank lending even much worse off than the non-OIC countries, whereas the overall OIC countries, bank lending is better than the rest of the world. So when we look at the fixed income, fixed capital, we have pretty much the same kind of trend. Now, we ran our regression, we gave you kind of a different, we look at the, how they go, how they interact with different type of financing, either internal funds or the fixed non-banking or bank financing, supplier credit and so forth, and we run the regression. The key, the message which comes out is that OIC countries, they're still, SMEs have to rely on internal funding, which means that they do not have access to a formal finance funding. The internal funds and the bank loans are very close substitute. There is another issue is that when we look at the OIC countries, they do have lack of access in the supplier credit, which means that maybe the infrastructure is not very well developed, but the supplier are not even willing to give credit to SMEs relative to rest of the world or non-OIC countries. If you sum up about the working capital, the message is very clear that SMEs in the OIC countries are in disadvantaged position. So that's not a very good, positive thing. If you look at the same thing for the fixed capital or the fixed assets, we do see the same kind of message that, surprising thing was that the export orientation had a negative effect in terms of the use of internal funds. So they're the area which could be any country which is more export oriented, that should be qualified for better access to finance. The SMEs in OIC countries do not benefit from the banking sector. It means that they do not have access to it. Overall, the message is the same, that SMEs are disadvantaged. Now, how the Islamic finance could be the catalyst. Now, one I was showing you that this, if you look at from the financial exclusion point of view, the World Bank also runs a survey every 2 years, 3 years called FINDEX, Financial Inclusion Index, and that shows that many of the Muslim countries, what is the percentage of people who would exclude themselves voluntarily because of the religion. If you look at Afghanistan, it says about 25% of the adults will exclude themselves. Pakistan, the ratio is about 6.8%, which is a bit surprising that the 6.8% people exclude themselves because of the religion, whereas the Pakistan report being launched and KAP study done by State Bank has given you much higher percentage. And Sri Lanka was surprising that over there about 14%, there's quite a sizable Muslim community, and they about 14% excluded themselves because of this thing. Now, why Islamic finance and SME? In a very simple thing, if we are asked to explain what are the key features of Islamic finance, I think you must have heard so many times. First is, of course, a risk-sharing finance, and asset-based finance, and a finance which promotes entrepreneurship. And then it also promotes trade, which means that actual physical, the trade of the physical and the real assets. It has emphasis on the materiality. It also emphasis about real sector finance, and of course we have heard about the ultimate goal is to have an economic and social justice. So when you bring all these things together, you immediately see that we have quite a good qualification for how Islamic finance could be a catalyst for SME, provided there is an environment given for this to them. So after running our analysis and doing our study, empirical study, we gave certain recommendations that what are the things which could be done for SMEs by different things. We know that we have a very limited or no access to the bank lending for SMEs. So that could be how you rectify that problem. One thing is that you review your current regulatory framework, which is to some extent is very much a replication of Basel III, and is basically very risk averse. It doesn't let banks take risk, although the Islamic banks are supposed to be a pass-through instrument based on profit and loss, but current regulatory environment in many countries do not allow them to be a risk. They kind of curtail their risk appetite. That's a major thing. So you need to rethink that how the regulatory environment could be modified to encourage in risk appetite, so they could go to SMEs. I think other thing is we have to look at creation of the asset-based finance. And for that matter, again, I was earlier mentioning the issue of non-banking financial finance is very important. Development of Mudarba companies, leasing companies, and these are the ones which are much closer to the client rather than big banks. So that needs to be explored and what can be done. Another thing is one need to understand what are the issues with keeping the movable collateral within the Sharia. And I think over here I would like to kind of share with you that the World Bank and ITTI are together working on a report which is basically trying to identify the issues that how a movable collateral can be used in a financial transaction. And as you know that SMEs have a lot of movable collateral. They do not have a fixed collateral as much, but they have a lot of movable collateral in forms of inventories. And that's where I think if such thing can be done, such framework can be developed, it can boost the SMEs. And I think there are other issues. We talk about credit, suppliers credit, which is I think can be, again, because Islamic finance is supposed to be an asset based. So a lot of these things can be developed with the exporters and the suppliers who can basically use these contracts of Murabaha and Salam to create these extend financing to the SMEs, because there's a less need for collateral because of underlying asset. And I think there's a lot of development happening in the SME sector and all over the world, thinking about digital platforms and bringing peer-to-peer lending. And I think that's where maybe the Muslim country, OIC countries in South Asia can have a reliance on that technology and mobilize a more risk-sharing based finance and more asset-based finance for SMEs. So now SMEs are known to be an engine for the economic growth. So if we are able to mobilize SME, then we can also mobilize the economic growth as well. So with that, I thank you your attention, and I hope it will benefit for you. Thank you so much.
Thank you, Dr. Zamir. Taking the admonition of Dr. Ishrat seriously, let me try to quickly summarize what this paper says in terms of looking forward to what actions to take in the future. Clearly, the point of the paper is that SMEs are finance constrained, and because of the reliance on bank borrowing, they are pretty much rationed out of the market, and it's a problem. Of course, SMEs are crucial to any economy. The solution for this problem is reliance on Islamic banking and risk sharing. And the reason that this will help is because Islamic banking is asset-based. Islamic banks themselves, because of their pass-through ability, are capable of providing ways and means by which SMEs can be financed. And one of the recommendations of the paper is to try to get the central banks to review the regulatory environment to make asset-based lending possible. The second thing is for central banks also to look at collateral provisions, to at least rely on movable collaterals, which is a new way of looking at provision of collaterals. And finally, to look at the supplier's credit. But also there is recommendation to try to get digital people-to-people or peer-to-peer financing platforms. And I think all of these recommendations should be taken up seriously. Perhaps one of the recommendations to the central bank is to look at the regulatory environment, clearly BIS could be satisfied if the movable collateral and this character of basically pass-through provisions that are available to central banks could be capitalized in order to help SMEs. Let me now move to the second paper, and Professor Dr. Kabir Hassan will present the paper.
Bismillahirrahmanirrahim. And this paper is written with one of my current student and former PhD student, Asem Al-Humaydi and William Hippler. Here basically I'm looking at the Islamic stock market and a sort of some behavioral assumption and some of the anomalies and some of the regularities that have been found in conventional stock market. So in Islamic finance, stocks can be classified into Sharia compliant and non-Sharia compliant, and actually Malaysia does that and many countries do that. An investor, depending on their faith, basically Islamic faith, will trade on stocks according to this classification, and they will hold only Islamic stock that complies with their belief, whereas other investors will be indifferent between these two groups. So in this setting, the market will be segmented. So Islamic stocks will be traded by a wider base of investors, both conventional and Islamic investors, whereas conventional stock will only be traded by a narrower or smaller base of investors. Now, I published a paper again, two of my former PhD students in Pacific Basin Finance Journal in 2015, taking the Saudi stock market for the existence of the Islamic effect, looking at the difference of stock returns between Islamic and conventional firms in Saudi Arabia. And our results indicate there is a negative relationship between Saudi Islamic firms and our stock returns, and we call them the negative Islamic effect. And we sort of build on this paper and extend that analysis by examining whether the return differences between the two classes of stocks are due to market segmentation caused by religious-based restrictions on portfolios of Islamic investors, or from liquidity effects caused by investor recognition, or both. We propose in our paper that Islamic stock could also be associated with share price changes that are not only due to the effects of firms' characteristics, but rather to investor recognition and information factors. And we claim that we contribute to the literature of Islamic finance by exploring a channel on which stock classification can affect investor recognition. So why? So as an experiment, we picked Saudi Arabia. And in Saudi Arabia, you'll be surprised to know that the majority of the stock trading are done by individuals, which gives us a very ideal experiment to test the effect of personal preference and religious beliefs on individual investors' trading behavior. If you look at the buy side in Saudi market, institutions only trade about 8%, and the 92% stocks are traded by individuals. On the sell side, the 91% are done by the individuals and about 5% done by investors. Just to give you a parallel with the US market, in the US, only 2% of the stocks are traded by individual investors. Now, having said this, so Saudi Arabia is 100% Muslim population, as is known for its strong adherence to Sharia. So this is in Saudi Arabia as a way of increasing the public awareness of Sharia rules. Clerics and Islamic finance scholars voluntarily screen stocks whether a stock following these two filters are Islamic and non-Islamic. And within this scenario, the Saudi banks also enter, especially Islamic banks, influx the stock market with individual investors through their personal loan product, Murabaha. How does it work? In Saudi Arabia, Murabaha loans are commonly generated using stocks, whereby banks sell stock on credit to its customers. The customers then have the discretion to choose among a portfolio of stocks, but the stocks must be Sharia compliant. As a result, the potential borrowers that may initially have no interest in investing in the stock market are incentivized to gather information pertaining to the Sharia compliance. As a consequence of these trends in Saudi market, the individual investors have become very active in trading Saudi stocks. What it means, as documented by the Tadawul, the Saudi Stock Exchange, the 90% of the stocks are traded by individual investors. Now, there are some theoretical paper, Martin 1987, provides a rationale for the effects of greater investor recognition in an extension to the original Sharp-Linter model. He shows that expected returns decreases with the size of the firm's investor base, which he characterizes the degree of investor recognition. And then there came Ironja and Losk in 1985, a theoretical paper basically showing that the market segmentation in international market. The Fang and Press 2009 examined the relationship between media coverage and the cross-section stock returns, and they find the significant return premium on stocks with no media coverage. So if a stock is followed by the media, that has less expected return compared to one which is not followed by a media. And another study done within the context of Sweden, they found the similar result. So where do you get the data? We collect daily and monthly data of all stock in Saudi Arabia from 2002 to 2015. We also collect macroeconomic factors on the Saudi Arabian market. We also collect the crude oil prices and the source of information from Saudi sources. And we calculate important measures including stock return, volatility, turnover, and liquidity. And we borrow these measures from other authors who have done studies in this area. Like stock market integration, there's a paper by Puktangon and Richard Roll, who's a Nobel laureate 2009, which is the R-squared computed from regressing stock returns on multiple potential factors that should explain stock return variation. Then we measure stock illiquidity by Amihud 2002, which captures the price impact of trading to the ratio of absolute return to trading volume. And we also measure stock idiosyncratic volatility ANG 2006 as the standard deviation of abnormal stock return relative to CAPM and former French three-factor model. Now, so we come up with the two hypotheses. We call this impediments to trade hypothesis. So if the stock classification represents an arbitrage opportunity, it can only persist if large impediments prevent rational investors from trading on it. We call this impediments of trade or illiquidity. Islamic investors refrain from trading on non-Islamic stocks, and the return differential may not reflect a mispricing, but a fair compensation for risk not captured by standard errors. We also hypothesize that the investor recognition following Martin, and we say that alternative explanation. So it's such stocks that are recognized, recognized by fewer investors need to offer higher returns to compensate their holders for being imperfectly diversified. So the results indicate that the stock classification does create a market segmentation. So we run all these statistical tests. I'm going to show you very quickly. By applying the first measure by Pukthang and Roll, measure of market integration, we find that Saudi macroeconomic factors can better explain Islamic stocks than do for conventional stock. Conventional stocks are undiversified and suffer from isolation as indicated by their high idiosyncratic risk. And Islamic stocks, on the other hand, are better recognized by outside investors indicated by their high liquidity measures. And using stock turnover and Amihud's illiquidity and following Logran and Schu's 2005 methodology, we find the Islamic stocks are anywhere between 20% and 24% higher than the conventional stocks in terms of stock turnover and liquidity respectively. So Islamic stocks have better liquidity and turnover, and most people are familiar with Islamic stocks. The results imply that the greater turnover Islamic stocks comes completely from systematic behavior. So here, if you can see, very fuzzy, so here the first one I show using conventional stocks and Islamic stocks. I regress them against the macroeconomic factors in Saudi Arabia. and by regressing stock returns on a number of macroeconomic factors that include consumer price index, central bank balance sheet, money supply, current account, capital flows, loan growth, monthly oil production, and Brent crude oil spot price, the results suggest that Islamic stocks are more sensitive to and integrated with the Saudi macroeconomic factors than conventional stocks. Then we look at the idiosyncratic risk. The difference in idiosyncratic risk between the two stock classes suggests that conventional stocks suffer from isolation and supports our hypothesis of market segmentation. Conventional stocks are traded by fewer investors because they are restricted from being traded by Islamic investors, which leads to conventional stocks being segmented and isolated from Islamic stocks. Therefore, conventional stocks have to compensate their investors in the form of additional risk premium for being undiversified. And the final one, the systematic and unsystematic turnover. The results imply that the greater turnover of Islamic investors comes from systematic turnover, which means that when investors trade stock for market-wide reasons, they trade the stock that they are familiar with. And more so, the investors are familiar with Islamic stocks. So what you find to conclude, of course, there has been a lot of data collection, data experimentation, econometrics. And finally, this is what we find. Just to conclude, we examine the potential of market barriers created by implicit, cultural, philosophical, religious among economic agents by studying how Islamic religious restrictions affect market segmentation and investor recognition in Saudi Arabia. The results show that stock classification affects the stock return possibly through two channels, creating a barrier between two classes where the Islamic investors cannot trade in conventional stock. This implies that conventional securities cannot be traded by Islamic investors. Therefore, investors who invest in conventional securities must hold an undiversified portfolio and thus require a return premium for bearing this idiosyncratic risk. Promoting Islamic stock by increasing shareholder base, which leads to Islamic stock being recognized by a wider base of investors and increase Islamic stock liquidity. And this finding supports that familiarity is an important criterion in determining trading. Thank you very much.
Thank you, Professor Kabir Hassan. Interesting paper. I think that for a long time, intuitively, one would think that in countries like Saudi Arabia, like most of the Muslim countries, one would expect far greater participation by individuals than institutions. Intuitively, because there are not much development in institutional investor sectors in Muslim countries. However, putting quantitative value on it, that 90% of investors in stock market are individuals rather than institutions is significant finding. Secondly, I think from my perspective, stock markets, as you know, are the first best instruments of risk sharing in an economy. During the 80s, there were this huge literature about stock market economies, that what happens if an economy completely runs on the basis of runs its financing on the basis of stock markets. So, but there have been very few studies on Islamic stock markets. We have a few papers on the Sharia requirements for Islamic stock markets, but most interesting result is the fact, to me anyway, is the fact that basically investor recognition plays a far more important role in Islamic economies than they do in conventional economies. So I suppose, Dr. Eshrat, one of the recommendations that I would take home from this particular study is that whatever, let's say, security commissions can do in Islamic countries to increase Islamic recognition of stocks, I think would be helpful to the economy and financing of SMEs as well as big corporations. Thank you very much. So for our third paper, I'll ask Dr. Saad to present the paper. Thank you.
Assalamu alaikum. While I was sitting there listening to the presentation, I realized something. So I'm going to confess it first before I start the presentation. The presentation that I've created today, only Professor Abbas Mirahur would be able to understand it, and not the rest of you. And I just realized that fact, unless you have recently done a course in optimization and maybe some advanced econometrics. So if you struggled in the later part of Professor Kabir's presentation, you're going to struggle greatly in what I have to present. So to rectify that, I was really hoping that most of you would have left by the time I present. And I was also hoping that probably I'll get a spot on the second day in the evening session where only a handful of academicians would be left in the audience to appreciate the ivory tower stuff that we have done. But with the help and with the permission of the chairperson, I would like to tone down the presentation. So I'm not going to present all my propositions which I had earlier planned. Neither would I show all the empirical stuff and the econometric methodology that is behind it. So the idea of what we do is very simple. Academicians, we like to sit in the ivory tower, and we feel the ivory tower is the best. President Kennedy once asked one of the Nobel laureates, James Tobin, to be part of his advisory council, and James Tobin replied that, President, I'm an ivory tower economist. But you know what, that's the best kind. And the president replied, you know what, I'm an ivory tower president, and that's the best kind. So I'll try to tone down the ivory tower stuff and try to make it as practical as possible. The idea is a very simple one. And the idea gained dominance in the aftermath of the financial crisis of 2008. So what caused the crisis? So I mean, just to make it more participative, if I can see a show of hands, how many of you think that conventional bankers caused the crisis of 2008? Okay, there are a lot of bankers in the audience, so I presume they would not admit that, but still, how many of you think regulators, they should have preempted the crisis, but they missed out? So I can see a greater show of hands. How many of you blame the credit rating agencies? Okay, again, most show of hands. How many of you feel that it was the poor borrowers who caused the crisis? Yeah, very few hands, and that's what I'm claiming in my paper. So very counterintuitive. So it's basically, and that's the recent research, that it was the borrowers. They might have caused the crisis, something that we've done a lot of blame game on the bankers, on the credit rating agencies, on the regulators. But what about the borrowers? What about the poor borrowers? So some of the recent work on behavioral finance suggests that borrowers, they are naive. In simple language, they're stupid. So what do I mean by stupidity here? So borrowers have certain behavioral inclinations which cause them to do things which a rational person shouldn't do. So for example, borrowers are loss averse. So when a loss-making event happens, they attribute a greater weight to losses than gains. Borrowers neglect extreme risk. So what do I mean by that? So a lot of us fear the Congo virus, right? In Karachi, I've heard it's a big thing, the Congo virus. Am I right? So now the probability that you would die of a car accident is much higher than you dying of a Congo virus. But still, we fear the virus more than when we are crossing the road. So that is what I mean by behavioral biases. We ignore what we call extreme risks. And in the work done by the Harvard professor Schleifer, one of the gurus of behavioral economics, he argued that because of extreme risks, borrowers, they should have provided market discipline by anticipating extreme risks in their decision making. So investors, borrowers as well as investors, should have incorporated extreme risks when making decisions. Now, why did they not incorporate the possibility that the world would be hit by a crisis when making a decision? And the idea is that they were persuaded otherwise. So there's a literature on persuasion that I'm trying to tap on. What do I mean by persuasion? A very simple idea. So I'm sure most of you have heard of the shampoo Sunsilk. So there was a time Sunsilk used to say that it contains silk. Now, silk has nothing to do with hair. It doesn't improve the quality of your hair. So why does the shampoo say it contains silk? Now that's a behavioral bias. That's called what we call persuasion. So the moment you read it contains silk, you'll associate the silkiness of the hair with the silk. And in technical terms, we call it co-categorization. So when we co-categorize things, we get persuaded much more easily. So for example, what do I mean by co-categorization? Other examples of co-categorization, when Arnold stood for, when he stood in the elections, so he would always call himself, I'm the champion. I am the strongest. So he wasn't the strongest in politics. He was a strong man in terms of his bodybuilding abilities. But he was transferring the association that we carry with bodybuilding to politics. Now, something similar happens to finance. A lot of financial institutions make use of transference and co-categorization to persuade investors and borrowers to making certain kind of decisions. Now, what happens when investors get persuaded? Now, momentarily, they would get persuaded because of trust and because of their behavioral inabilities. But the way we have been created, eventually we realize our folly. So that's the essence of the paper. And when we realize our folly, we overreact. And we have argued in the paper using, there is what you see in front, these are optimization models. We have argued based on work of Mullainathan, again a professor at Harvard, and Schleifer, both of them professors at Harvard. We have extended their literature. And we have argued that Islamic customers are also prone to persuasion. Hence, there would be an increase in demand, but the industry would also be exposed to risk. What do I mean by persuasion? So when you say it's halal, in the mind of the customer might also be thinking it's less risky. Halal means good. So he might not or she might not be attributing or might not be understanding the true risk-return characteristics of the instrument. And we have argued that when this happened, there was an oversubscription in the first phase, and there is a crisis in the second phase if a bad event occurs. Schleifer showed it for the 2008 financial crisis. They argued that since investors were naive and they ignored extreme risks because of their coarse thinking, it resulted in oversubscription, and when the news hit that a crisis is about to occur, they overreacted again, resulting in a crisis. So we've argued in the paper that Islamic finance industry might also be prone to, not the extreme financial crisis, but might also be prone to what we call behavioral risks of the individual, where the Islamic customer might overreact to certain news. And then we have shown empirically that Islamic customers have overreacted to AOFI statements, where the market experienced certain plunges when AOFI issued a particular statement. So what are we proposing? We are proposing very simply, we are proposing, again, what I've presented might sound very intuitive, but what we are proposing here is that the customer needs to be more educated. So as the customer's understanding of these financial products would increase, this would help add robustness to the industry. And if the customer is relying, again, too much on gut feeling, then this would expose the industry where the customer might experience a plunge on just the outcome of a bad news. Coming back again, it's very behavioral in nature. So we have brought back the individual in the picture. So people argue that it's always about the institutions or the regulators, or it's about other bodies. But we have argued it's about the person that you are serving, and that person is human. The person is not just rational. The person cannot just make quick calculations. The person is human. With that, I finish my presentation. Thanks.
Thank you very much, Dr. Saad, for a presentation of a very good paper. As you were talking, I thought about what would you do with Kahneman's idea of framing, because after all, yes, consumers were naive, but at the same time, they were presented huge incentives through ninja loans, and no jobs, no income, and basically no down payment. You come and borrow whatever you want. And this framing, I wondered how much it could help in terms of appeal to the consumers vis-a-vis the Islamic finance. Because we've been told that part of the problem with the consumers is lack of education. And that lack of education may be precisely because the question of Islamic finance is not framed correctly. For those of you who are not familiar with the work of Kahneman, for which he received Nobel Prize, basically for a simple example of it is that I can come to you and say I have a project with a probability of 80% good returns, 20% failure obviously. I can go on and change that and say I have a project with 20% failure. Even though it's the same project, you are more likely to go along with the first one than with the second one. So the question of framing to me, and also the result I think of this study, is basically how do you get the investor first educated, and that education has to be put into a frame that is acceptable or more appealing. So that's the recommendation for you. And I hope, Dr. Ishrat, you're writing these down. So you said you challenged us that we all have to come up with workable means of pushing the agenda forward. With that, I thank all of the speakers for very good papers. And I hope that you will do more, both of you, because these are areas that have not been explored. And I thank you for listening. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you, Dr. Saab.
Sorry? One comment, please. You need to have a microphone. Is there any more? Yeah, there is one. Oh, I think it's not. There you are. Yeah.
I just want to point out that when we are saying in the conventional finance and in the global financial crisis, it was the overwhelming response from the customer side, and the customers became one of the reasons of the global financial crisis. But in case of Islamic finance, it could not be that case, because in Islamic finance, it is the risk sharing from both sides. Even from the supply side, that cannot be that well, and even from the demand side, the customers cannot be that participatory, and they have to understand, and they most of the time understand the risk sharing behavior and the asset-based system in the Islamic finance. That was the one comment on what you were talking about.
Would you care to respond?
Thanks for the comment. The essence of my paper is that whenever there is financial innovation, there is complexity. And when you try to explain that complexity to customers, customers at times find it very difficult to understand the complexity. So when you talk about CDOs or CDS, there's a lot of complexity that the customer cannot understand. Now, when they cannot understand it, they won't be able to price it in their decision. In a similar fashion, irrespective of whether the product is risk sharing or risk shifting, there are complexities attached to the Islamic product as well. So there are risk and returns attached to the product which the customer might not be able to appreciate when making that decision. Now that would expose the industry to that, what we call negligent risks or neglected risks. That's the proper word. So there are always neglected risks attached to in the system whenever there is financial innovation, and that was the essence of my work.
Thank you, Dr. Professor Dr. Abbas Mirakhor, Dr. Zamir Iqbal, Professor Dr. M. Kabir Hassan, and Dr. Saad Azmat. Thank you for your papers. And I request the volunteers to please get ready along with the plaques, and I request Dr. Ishrat to please join us for this small plaque distribution ceremony. The first plaque will be presented to Professor Dr. Abbas Mirakhor, the chairman of this session. Dr. Zamir Iqbal for his plaque. Professor Dr. M. Kabir Hassan. And finally, Dr. Saad Azmat for his very energetic paper. We must appreciate the level of energy which he transmitted. Thank you very much. Thank you, Dr. Saab. Ladies and gentlemen, before going for lunch, another announcement that this event is sponsored by a number of companies. We have a lot of partners, and it's very important that I mention the names of those partners and sponsors. The gold sponsor of this particular event is Pak Qatar Family Takaful. Mizan Bank is the strategic partner for this event. Then we have the research partners, which are IRTI and ISRA. INSEEF is the academic partner for this program. Then we have the supporting sponsors comprising of Al Mizan Investment Bank, Al Mizan Investment, Dubai Islamic Bank, Al Baraka Bank, Bank Islami, and Chartered Institute of Islamic Finance Professionals. We have a publishing alliance with Palgrave, Macmillan, and Pacific Basin Financial Journal. Then we have CSR partners with Ahsan Trust, PR partners, Bridge Public Relationing, and international media partner, IFN, and media partner, Aluda. We are grateful to all of them for their support. And now we break for lunch. Just a couple of announcements. The prayers arrangement for male is right at the pool side at prayer area, and for female, we have arrangements at Jasmine Hall next to Albistan. This is a 45 minutes lunch break. Inshallah ta'ala, we will gather for the third session at 2:45. 2:45. Thank you very much for this session.